Alicia.
Well, taking a look at the market's performance yesterday, despite that pullback, there's still an expectation of a possible run by the bulls on the Nigerian Stock Exchange. But we've been hearing all this week that what we're missing is any near-term catalyst to actually ignite, this growth momentum or upward momentum moving forward. What's your view on the activity that's playing out right now?
Yeah, thank you, Alicia. The Nigerian market has, quite rightly noted, has experienced quite a significant run of the bears in recent time. In fact, that is actually gone beyond our own even expectations. The overall sentiment for the market is that there will be some significant bullish run on the market for the year in terms of an outlook. The significant near-term drivers obviously are lacking. I think the market had previously priced in whatever positives may have come out of the AMC, and that obviously is why, despite the fact that it's been properly documented right now at the legislature, just waiting on presidential accent, not much has seemed to come out of that. I think the other major challenge, and which has obviously led to the significant bearish run, has been that a lot of the numbers that have been released recently, by most of the companies across sectors, has shown little or no growth in terms of top line, and a lot of the bottom line has been challenged.
Well, taking a look at just a recent development, yesterday we've heard that the SEC has penalized 92 market operators. What has that done to sentiment right now? Because while it may enhance confidence moving forward, it also puts very big question marks around these market operators' abilities and transparencies.
I think for one, there has always been a question surrounding the transparency and the kind of operations we've seen in the market. There have been calls for reforms to that sector largely, and I think primarily what the DG of the SEC is trying to do is essentially try and clean out the stables, much the same way as the central bank and a few other regulators are trying to get the companies to begin to report better numbers, a bit more transparency. It only behoves the regulators that govern operations or operators in the market to also do something that light.
Well, taking a look at where, that kind of reform and that kind of regulatory oversight has had an impact, it has been within the banking space specifically. We've seen, though, that if you look at a few of these stocks in the space, First Bank, GTB, UBA and Zenith, all trading at multiples of about 1.5 times, and it represents about a 66% premium to the Tier 2 banks that are listed. That's the likes of Access Bank, Diamond Bank, First City Monument Bank and Sky Bank as well. To what extent can the valuation gap that we're seeing amongst these players, between the big four banks and the Tier 2 banks be explained by liquidity?
Well, I think quite rightly noted. I think the significant gap in valuation obviously stems from liquidity in terms of the volume traded per day. For the top four banks you've listed, First Bank, GT, UBA and Zenith, we find that average trading volumes for those banks is in the between $2 to $2.5 million per day range. That's slightly down from just over 3 million same time a year ago. For the other banks, we find that it's significantly less, and I think part of that is obviously what has accounted for a preference by investors for stocks with significant liquidity. In terms of total returns to shareholders, I think there isn't much of a gap between those two sets of banks. So clearly there is a premium placed on those four banks, which in some respect obviously stems from greater transparency as well.
Well, certainly lots of activity still surrounding the banking space, but there are other counters stealing attention, and on the basis of the fact that they do boast fundamental support. One of those one of the sectors that includes comes from the cement, the building sector specifically. Out of that space, we saw Ashaka Cement out with numbers yesterday for the full year, but reporting a significant drop in PAT, down 54%. Market reaction to those numbers?
Market reaction has been, slightly negative. Obviously, the expectation for the construction or infrastructure space, as we would like to call it, has been pretty bullish, because the expectation is that, given government's commitment to investment in infrastructure, that those companies stand to benefit significantly. However, Ashaka's numbers yesterday were, pretty much against the grain of expectations, and therefore we expect that the market may punish it in the near term.
Well, of course, we'll be checking that share price movement as we progress through the session today, waiting for investors to actually digest that news fully and for that to reflect on that share price. Thank